In the press these days, you'll hear a lot about minimum volatility funds and low volatility funds and investing using a very, very conservative style of for stock funds. We have with us today Wes Crill, Senior Investment Director at Dimensional Fund Advisors. And Wes, I know you've written and researched this topic in the past. Could you explain what exactly is the intent and design of these funds, and maybe look at the other side of things?
Yeah, a little bit of trivia. So the first white paper I wrote for Dimensional back in 2011 was actually about low volatility style strategy. So as you can see, this conversation has been going on for quite a while. The basic premise around low volatility strategies is that they're portfolios that target stocks that have had low volatility, whether that's prior return standard deviation, whether it's low market beta, if you were to rest their returns on a market factor. And the idea or the supposition is that this is a persistent characteristic, that they were low vol in the past, they'll be low vol in the future. And these types of strategies, I think, become attractive to investors when you're going through turbulent markets or coming out of a market downturn, because by design, they're going to be targeting less exposure to the overall equity markets movements. Now, the real question for investors is that the best way to go about dampening market volatility? We already have an excellent asset out there that is shown very reliably to reduce market volatility, and that is fixed income. So traditional balanced portfolios that combine equities and fixed income can markedly reduce volatility compared to a portfolio that's 100% stocks. And what the research shows us is that if you're looking at your overall portfolio volatility, the precision with which you reduce your portfolio's volatility is actually more reliably accomplished through traditional balanced portfolios, so just equities and fixed income, than it is by using low volatility strategies. And that's because a low volatility stock portfolio is still holding stocks. Stocks are still generally going to be higher volatility than bonds. And so you can see through time how that is a less precise way, less predictable, I would say, in terms of your overall volatility reduction.
Yeah, I think it's interesting that most of the research, at least I've seen on low volatility, always compares low volatility to high volatility stocks. They don't bring into the equation bond funds, which are very accessible and low cost for investors.
Yeah, exactly. It's sort of like if you're focusing on a recipe for cooking something and you have different components that are going to go into the recipe. And if you're only evaluating a change to one of the components going in, it doesn't take into account when you're combining. So if you have self-rising flour, well, that's not going to matter if you end up adding baking powder or baking soda later into the recipe. So evaluating investments within a sleeve like that, so only looking at the volatility of your stock portfolio, is not as comprehensive of a measure as just looking across your whole asset allocation. If you have something other than stocks in your portfolio, that could be managing the risk in a more precise way than trying to do something specifically within the equity sleeve.
Well, that makes a lot of sense. Thank you very much for your time today.
Yeah, of course. Thanks for having me.